Hello and welcome to CIMA Australia's exam preparation series. My name is Cliff Bowles. I'll be your presenter for these two films for February 2015 Management Case Study Exam Preparation. This is film 1. And as I've said in earlier exam preparation films, I recommend that you follow a process to analyze or at least get to grips with this pre-seen case study. As you know, the case study is available about 6 weeks before the exam. What I've suggested is that you download it as soon as it becomes available and make 3 copies or print 3 copies of the case study. And read copy 1 through quite uncritically, at least 3 times before you start to do any analysis, and leave a couple of days between each reading to let the scenario become absorbed into you. Then go through copy 1 of the case study with a marker pen and highlight anything at all that rings a bell with you or stands out as significant, but don't be too analytical at this stage. Then wait a couple of days, and then without consulting copy 1, mark up copy 2, again with things that seem significant to you, but don't try and analyze anything, just try and identify things. Then before you do a third review of the case study, have a look at the syllabus, just the summary of the syllabus, and try and get a feeling of what this case study is going to represent. In this case, we're looking at the management case study, and as we can see here, the management level translates the strategy decided at higher levels. So maybe as a board of directors they decide some strategy, and the management level communicates it to lower levels for implementation. It monitors and reports on the implementation of strategy and ensures corrective action is taken when required. So it has a medium-term focus. Now we also want to understand, and I'm sure that you do, what is in the syllabus for this level, E2, P2 and F2. And as we can see, there's several groups of learning outcomes that are listed here. It would be completely crazy to try and take the exam without having done a great deal of studying of each of these parts of the syllabus. Another thing we need to do before we start on the final markup of the case study is to look at the role that you will be playing in the case study. And the role in the management level is literally a manager. And you're going to be reporting, your audience is going to be the CFO, Chief Financial Officer, and senior business managers. And some of the areas that the exam is going to focus on is consideration of key stakeholders, E2, implementation via projects. In P2, the exam focus is going to be on product and pricing decisions and/or the performance evaluation of divisions or component parts of a business. And in F2, the impact on the financial statements and the performance of the organization. So what sort of questions might we have in the back of our mind when we do this final walk through the case study and identify the things that now seem to us to be important? Well, some of the potential issues that we might think about are: who are the stakeholders? Are there any active projects going at the moment? Are there any obvious pricing differences? Are there any gaps in divisional performance measurement? And which elements of the financial statements might need to be looked at carefully? And finally, before we look at the case study, what I did was to take the elements of the syllabus and sort them by weighting percentage to see what priorities might be necessary to focus on. And as you can see here, the biggest single element of the syllabus seems to be financial reporting, which was 60% of F2. The others, introduction to strategic management, change through projects, 30%. So there's nothing here that, apart from this, that really stands out. So when we're looking at the case study, we've really got to think about financial reporting, but we've got to have the others in mind as well. So what we're going to do now is we're going to take copy 3, if you like, of the case study, and I'm going to mark it up with the things that seem relevant to me at this level. So this level is about monitoring things in the medium term. I've got that in the back of my mind. And when we look at the case study, we might look at and have in mind, these are the things that we're going to get tested on in the exam. So we might just have these in mind as we're going through the case study. So I'm going to go through the case study now, mark it up with the things that I felt are important, or more particularly, what sort of questions arose when I looked at the case study. And in film 1, we're just going to mark up the case study and, if you like, ask questions. And in film 2, we might take some of those questions and investigate them further and look more closely at what questions might arise in an exam, or what issues possibly might arise in an exam, and how we might deal with them. So let's have a look at the case study, and this is the third pass of the case study. So here's the management level case study. The exam is going to be early March 2015, and the pre-seen material, which is what this case study is, was released in February 2015. So the case study is about a company called Build, B-I-L-D. It's a construction company, and what I'm going to do is go through the case study, and I've highlighted the areas that have a question or seem significant to me, and I'll just comment on them as we go through. So what I've done is, as I've gone through, is I've highlighted the areas that I feel are important. I'm not saying that they're the only areas, but for me, as I was looking through the case study, this is what struck me. You may have quite different things that jump out to you and say this is important. And each of us is different, of course. So the first one is Build is the third largest construction company in its home country of Sealand, and Construct More is its biggest competitor. So we've got third largest, Build, the largest is Construct More. My question is, who's the second? And we don't know anything about it, but there is another large competitor there that isn't mentioned. So we're just highlighting that. The business is highly competitive, the market is highly competitive, and Build is well established and has a good reputation. So as in many parts of the construction industry, clients of Build generally invite construction companies to bid in a tender process, a selective tender process for construction contracts on a competitive basis. We find out later that Build is separated into 3 subsidiaries. Civil engineering is one, which is the biggest one, and the second one is called development. And what development does, it says here, has some speculative ventures of its own. So the word speculative comes to mind here. Speculation means risk. It buys land as an investment, and sometimes it builds projects such as office blocks with a view to finding a buyer once the building is completed. My first note as I was going through the case study for the third time was I wrote down capital approval process, question mark, question mark. So I don't know about that. It doesn't mention how are these projects, these speculative ventures, how are they chosen? Is there some process that we need to know about? The third subsidiary is called investment, and we're told that whenever Build's development subsidiary can't find a buyer for one of its completed buildings, so obviously it's happened, they've speculated and made a building and can't find a buyer, they transfer that building to the investment subsidiary. The investment subsidiary generates rental income from these buildings with a view to selling them at a profit whenever the market conditions are favorable. My immediate question is, why have we got these 2 separate subsidiaries which appear to do similar things? So again, I need to follow that up as we go through the case. Page 3 describes a typical civil engineering project. It's driven by client specifications, and we're told a major project can take several years from design to final completion. So these are not short-term things. As anybody who's done tendering will know, it takes a great deal of time to prepare a bid, and if build is already heavily committed to other projects, or if the project appears unlikely to generate a profit, then build may decline to bid. A typical project undertaken by civil engineering will take between 2 and 5 years to complete. So if build wins a contract, then it appoints a project management team and a project manager. Subcontractors do most of the work, but build is responsible for finding and employing subcontractors and for paying them. Construction equipment often hired for a particular project, and apart from the land, all of the other costs are the responsibility of the construction company. So it's a very important thing to get your tender right. As usual in these civil engineering projects, there will be progress payments, stage payments as part of a contract, and the client will inspect the work and make sure it's of an acceptable quality before these progress payments are made, or that certain project milestones have been met. So that's pretty standard for projects in the civil engineering. Once the project's completed, it's handed over to the client and a final invoice for the balance of the contract price is issued, and there's some retention money, 3 to 5% of the total price, so it's not insubstantial, and it's often held for an agreed period, perhaps 1 year after completion, to deal with small defects that appear as the building settles down and the construction company is required to carry out remedial work. So I would suspect that's the same for all people all contractors in the. We're given information about build and the country it's operating in, country of Sealand, and the currency is $1. And Sealand has adopted IFRS, International Financial Reporting Standards. It's a prosperous country. It's an island. Good international trading links, although it appears from the case study that all of their work is done within Sealand. Their capital city is located in the southeast of the country. Most of the heavy industry and manufacturing is in the north. The southwest region is rural and mostly agricultural, so you'd think there wouldn't be a lot of activity there. Sealand's climate is temperate with a rainy season from November to February. If we go further on into the case study, we see that there's a September year end, and with rainy seasons, if you ever go to the north part of Australia, where there's a monsoon for between, let's say, November, December and February, the building work can be severely affected by weather. So again, we've got this idea that there may be some seasonal variation in activity. Most important, job description. You're the senior management accountant at build. That's your role that you must play, the senior management accountant. So that presumes that there are other management accounting staff, but you're the senior one. And your role in the organization is to provide information to the finance director, who will meet shortly, to enable the company's performance to be measured and for decision-making purposes. Now, as we go further on, when we look at the board of directors, we'll see that there's a group financial director. I'm assuming, and that may or may not be correct, that this is the person that you're reporting to. Her name is Felicity Bunyan. So let's have a look at the organization structure. We've got the parent company, Build, head office. We've got 3 subsidiaries, Civil Engineering, Development and Investment. And Civil Engineering has 4 subsidiaries, geographically located southwest, southeast, central and north. And there are 2 other subsidiaries, Development and Investment. The head office is in the capital city, and these 3 subsidiaries also operate out of the head office building, and the 4 regional subsidiaries have their own separate offices, each located in its respective. So let's have a think about this structure for a moment. My first thought when I saw this organization chart is, why are these 2 separate? We've got 2 separate management teams, 2 separate offices, 2 separate organizations. They do similar things, so it seems to me we need to understand, why do we need 2 major subsidiaries here? Why can't we just put them together and make one? And something really strange here, to me it's strange, we've got 2 south subsidiaries, one southwest, one southeast. Southwest is supposedly rural, mostly agricultural, and yes, it's got a subsidiary. And north, where you'd expect to be northeast and northwest, only has one subsidiary. This is where most of the business activity takes place, and this is the biggest revenue earner. It seems to me that we should maybe consider amalgamating those 2, and if necessary, separating those maybe into 2 subsidiaries, if necessary. So there's a big question for me about the organization structure, or big question. So further on, we learn that each contract has a team of site agents, and it says here the site agents also raise purchase orders for building materials, and the site agents are supported by architects, engineers, and so on. So my question was, each of these subsidiaries has a series of site agents, so obviously the purchasing of building materials is done independently in each subsidiary and in necessary for each contract. Wouldn't it be better, this is just a question for me, to have all the building materials done at this head office so that they can be consolidated and cost savings made, or different benefits arise from amalgamating purchase orders? Can we centralize it? The regional subsidiaries operate independently of each other, so there's obviously a management team in each of these subsidiaries. Each reports to civil engineering on a half-yearly basis. Well, that surely is too long. Only to get a report every half year would seem to me to be very, very insufficient. Civil engineering amalgamates or consolidates these reports into a summary for the main board to consider. So the board is only getting some feedback from each of these subsidiaries every 6 months. The board receives a high-level report summarizing the key results of each of these 3 subsidiaries. So here's a typical budget actual report, or a management report. Actual results are reported against budgets for key performance targets. So the regional CEO provides a brief commentary. Well, brief commentary after 6 months, probably insufficient, explaining why variances have arisen. What we need, first of all, to perhaps we need maybe another column straight away to actually look at the variances. And Build Southwest has historically been the most profitable regional subsidiary, with results consistently in line with budgets. So we've seen earlier that we're told that Southwest was a rural area, mostly agricultural, and yet here we're saying it's the most profitable regional subsidiary. So maybe we need to have a look at that more. We need to maybe have some more knowledge about what each of these subsidiaries is doing. But let's have a look at the management report for the 6 months to March 31st, 2015. So we've got some performance indicators here, or performance measures. We've got budget, we've got actual, we need a variance perhaps. And obviously the first question would be is to say, well, why have these performance measures been chosen? Are they the most appropriate? For example, new work bid for. In that 6 months, we bid for that and we've won some contracts, 530. So what is the norm? I mean, how does this norm, is this percentage of contracts won to bids, is that typical? And so we perhaps need to know something about that. Progress payments invoice, retention monies released. Again, what is the importance of this? How relevant is it to the performance of this particular subsidiary? Cost of work scheduled, CWS, cost of work performed. And again, what is the relationship? What do these schedule variances actually mean? We'll look at this in film 2, of course, very carefully. But does this tell somebody that doesn't understand the relationship of work scheduled to work performed? What does it mean? Does A adverse? What does it actually mean? What's it telling us here? There's no interpretation really down in the commentary by the CEO. So I find these particular performance measures very bland and really not very instructive if I wanted to know what was actually going on with this business. And we might look at this, what might be the performance measures that might be important in film 2. So here's the commentary by the CEO. Again, it's incredibly brief, given it's a 6-month time delay before these things. So after 6 months, that's pretty, I would have thought, unacceptable. Results for the 6 months have been disappointing. We've had fewer opportunities to tender for work than we originally anticipated. Well, we can see that. We don't need to say that. We can see. We also won just over 30% less work. So that's a double negative almost. We won 70% of the work we budgeted for. Might have been a better way of saying it. Importantly, this will leave us with excess capacity for the next 3 months, but no comments here about what they're going to do with that excess capacity. Could it be used in other subsidiaries? What's going to happen with the people that they've got? So it just leaves us dangling there. We were successful bidding for smaller contracts, but the large competitor Cont'd outbid us on 2 large projects. This was disappointing because we'd undertaken for the work for these clients in the past and they'd been happy with the quality. So they've lost some clients. Now this is important. It appears that Cont'd undercut our bids for these contracts. So in a competitive environment, a bigger player is cutting margins and you're losing work. That has to be of great importance to senior management, one would have thought. And there's nothing here to say, well, this is what we're going to do about it. So stock market and corporate governance, there's really not much, well, there's hardly anything about corporate governance. If we look at the share price currently, despite being stable for the last 3 years, is at its lowest price in the company's history. And what you can see is share price indices, Built and Cont'd. And notice this index here, this is not the share price, this is an index, so it's a comparative based on 100%. But if you can see that since September, maybe September, July 13 to January 15, the difference between the share price indices for the two has started to grow, and something seriously happened in January 15 for the market to react in such a severe way. We don't know what that is. Presumably some event has occurred. Maybe the unseen material, the new material that you're given at the exam, might explain what the cause of that sudden share drop is. We have some information here about market data. We see the word beta, we see the words market premium, we see the words risk-free rate, and immediately you need to write next to that CAPM, capital asset pricing model. Some question is going to arise about that, and we'll come back to that in film 2. So now let's have a look at the board of directors. We're given quite some information about them. The CEO has been with Built since 1994, so it's 20 years, has led many successful construction projects. The group finance director is a qualified accountant. It doesn't say what type of accountant. A lot of knowledge of the construction sector. She's worked for a number of organizations, including an engineering company in Australia. So part of the board of directors are the managing directors of the 3 subsidiaries, starting with Mark Grassington. He joined Built from their major competitor Cont'd. He worked for the South East subsidiary and obviously was interested in quality. and introduced an initiative before being promoted to MD in 2013. The MD of Build Development is Nigel Fanshawe. He's a chartered surveyor. He comes from Chuffington's, a firm of surveyors which has provided advice for Build. And the managing director of the investment subsidiary is Amanda Hesselman, who comes from a major merchant bank. She's qualified as an accountant and a chartered surveyor. So what can we say about this team, first of all, before we look at the non-executive directors? They're obviously all familiar with construction projects and a lot of experience in the industry. Perhaps you might consider that there's nobody there that has a marketing background or a strategic background. Certainly for managing a public company, it's a question mark for me. Is this board diverse enough to be a public company? It's a question we'll look at a bit more in film 2. Making up the rest of the board is Melissa Woods, a company secretary, qualified lawyer, and she also is responsible for the HR department and has a responsibility of addressing the implications, the staff implications of Build's business strategy. And then we have quite a number of non-executive directors. That's good to see. The chairman, Daniel Craigie, came to Build as a non-executive director in 2010, appointed chairman in 2012, and previously a finance director for another major company in the construction industry. Jesse Hardbottom, independent director, chair of the audit committee, a trustee of a charity, successful career as an academic. One of the things that I was taught, if you're going to have somebody in the audit committee is responsible for the financial statements and links with the auditors, you need somebody with finance experience, and that doesn't appear to be the case with this person. The next one is Nimrod Eskurgian, I think if I'm pronouncing that correctly, member of the audit committee and the remuneration committee, distinguished career in the public sector, former town planner. Again, what experience have they got in finance and remuneration in a public competitive industry? That to me is a bit of a problem. We have another independent director who's experienced in sustainable development, environmentally friendly construction methodologies, chair of the remuneration committee. Again, what experience does that person have of understanding how to pay people in a competitive public company environment? And Hugo Hunter is a chairman of Hunter & Waddell, a property investment company. He's a member of the remuneration committee. And I highlighted a property investment company. Is this a good thing or a bad thing? Not sure yet. It's just a question mark. So now let's have a look at the financial statements. This is the consolidated statements of profit and loss for the year ending 30th of September 2014. The cost of sales is very high, and when we look further on, we'll see that cost of sales of 90% seems to be quite normal in this industry. So again, we need to understand that. The other operating expenses are increasing. They've gone up by about 50 in a year. The tax is, if we look at the tax percentage, in 2013 it was 35%. We're going to learn later the tax rate's 35%. In this year it's 42%. We don't understand why. We need to maybe look at point 4 and see if we can find out about that. What would be important, of course, is to benchmark some of the ratios like PE ratio or earnings per share with Constructmore, which we've got some information about that. The other point I noted was if they're under IFRS, where's the comprehensive income? Is this in the format of IFRS? And again, we'll come back to that in film 2. So here's the financial position, the consolidated statement of financial position as at September 2014. I've highlighted a few questions here. There are many you could ask, but we can see that the amounts due from construction clients has increased significantly. This obviously to me is the most worrying. The cash 19 million. It's gone down from last year of 67 million. And if we go down here and look at borrowings, borrowings have increased significantly. So cash is down 48 million and borrowings are up 57 million. So that to me is of great concern. Assets held for sale, I'd like to know a little bit more about those. What does that represent? I'd like to know a little bit more about deferred tax, although it's only a small amount. And something that is a puzzle to me, the tax liability here of 15 doesn't match the statement of profit and loss, where we've got a tax liability of 132. So I need to understand, why is there a difference here? Why is this 15 instead of 132 or some number thereabouts? The consolidated statement of changes in equity, balance at the 1st of October 2013 to the September 2014. Profit for the year, it ties up with the profit and loss account. Dividend paid, 121 million. So for a company that's running out of cash, this is obviously an issue. Should they be paying dividends when they're running out of money and borrowing? We need to come back to that and have a look. In the notes to the accounts under revenue, we can see that about 10% of the revenue is proceeds from the sale of developments. So these are one-off sales, they're not ongoing revenue. By comparison, they're probably 10%. When we look at property, plant and equipment, we have a charge for the year, 23 million, which seems pretty low. And we have some disposals here, yet we don't seem to appear to have a profit or loss on disposal in the income statement. So again, that's a question mark for me. The directors carried out a review of values of property, plant and equipment, didn't find any evidence of impairment. Well, I think we need to go back to the standard and see what it says about evidence of impairment, what is allowable and what is not allowable. I wouldn't have thought directors making judgments about the values of property, plant and equipment would be appropriate. We need to go back and look at that. Note 3, share capital, 240 million shares of $1. So given that, we can work out some things like earnings per share and PE ratio. We've got the share price at September 2014. So if the share price was at 2014, given the share price index graph that we looked at, we could probably work out backwards what the share price was at any given time and what the share price is today. The corporation tax rate in Sealand is 35%, so we need to look at the tax and see if that number makes sense. So as we learned at the beginning, Build complies with IFRS. And some notes about property, plant and equipment. Property, plant and equipment is held under the revaluation model in accordance with IAS 16. Items of PP&E are carried at the revalued amount, being the fair value at the date of the revaluation. Reviews are carried out by directors on an annual basis. We've said we need to check what the standard says about that, and to ensure the carrying amount doesn't differ materially from fair value. Every 5 years, an independent valuation is carried out by a firm of professional surveyors. The next review is due in 2017, so by deduction, we could say the last review is 2012. Has that got anything to do with the start of the share price reduction? We don't know. Leases on plant and equipment are classified as operating leases, so they're off balance sheet. Lease payments are recognized within cost of sales in the income statement. So how much has this company got as operating leases? And we need to see a breakdown of the cost of sales before we can answer that. So the next piece of information is called principal risks. The first questions I have about that: what is the source of this information? What is the date of this information? When was it done? Who did it? And why was it done? So we're not told any of that, so we need to perhaps understand that. So the risks, is this the risk to the whole company? Is it a risk for a particular subsidiary? We don't know. So let's have a look at the risks. failing to win contracts, leading to reduction or failure of targets in revenue and growth. And what we've got is some mitigation, listening to our customers, implementing cost reduction programs. I can't find any evidence that there's been a cost reduction program. In fact, it looks to me like costs are going up. So we need to find out much more evidence of this compliance with this. Listening to customers is a good idea, but that's a bit vague. Who's listening? How? There's no point in just listening. You've got to translate that listening into some action. So the next risk is problems with operational delivery or cost overruns, time overruns, and mitigation is the work on site is checked by in-house professionals, reports prepared, so corrective action. So that really doesn't stack up with the management report we saw for Build Southwest, where we had an adverse schedule variance and adverse cost variance. So again, is this really happening, or is it just nice to have? The next part, the board is responsible for the overall quality issues and reviewing best practice. And my note when I was reading this is this sensible? Why can't you delegate this to the management teams? Why is the board doing this? The next one, the success of the business is dependent upon sufficient financial facilities. Says who? The success of the business is based upon being able to borrow money, and borrowing facilities have been successfully renegotiated and extended. Well, I would have thought the success of the business was on winning business and getting a good margin. Being able to borrow money is probably not the right sort of focus. The next one down here is the business depends on flexible, skilled, well-motivated workforce. If they're not able to attract and retain skilled people, then business growth may not be possible. Staff turnover is monitored. We haven't seen any results. And obviously in a competitive environment, keeping good people, retaining good people would be very, very important. Finally, future construction orders depend upon the economic climate and the availability of credit for private sector expenditure. Again, we need to understand what they're talking about here. What is the risk here? It depends on the economic climate. That's a general risk for everybody in the industry, of course. The availability of credit, and so we'll come back to that in the information later on in the case study. The board carries out a quarterly review of workload. Again, a quarterly review, that's too long. Build has a network of regional offices throughout Sealand providing strong integration with our client base. Again, that could be a good thing, but it also could be an expensive thing. So here we have an extract from the chairman's statement. I had quite a lot of problems with this. Let's go back to the information we're given, and we can see that this person Daniel Craigie has been the chair of this business since 2012. Is it a coincidence that the share price started to diverge against its competitors since 2012? Is he performing well? Don't know. Let's find out more. So the first thing, I'm happy to report a very positive set of results. Well, in most public statements by chairs or CEOs, you get the good news. They don't tell you the bad news, but anybody who reads the accounts can see that this is not a great positive set of results. It's okay, but a very positive set of results, I don't think so. And then he says it's remained profitable despite erosion of margins. So where you're getting erosion of margins, we need to start being concerned. Profit has been supplemented by a property development subsidiary, including the successful sale of our major office development. Again, we need to know, was that a sale that made some profit? We don't know that yet. In addition to the valuable contributions, our investment and development activities also provided a solid asset base on which to secure borrowings. So that word secure, does that imply that the money that's been borrowed, the extra money, has been borrowed on the basis of giving security of assets? We need to be very clear about that. Our asset base has enabled Bill to sustain gearing levels well in excess of our main competitors. He's writing as if having a high gearing level, higher than our competitors, is a good thing. Well, is it? Having lots of debt means you've got to pay it back. You've got lots of interest, and you've got lots of more risk, and you've got a lot less ability to do things like undercut your competitors unless you've got a lot of money in the bank. So I don't think that's a very good thing. We're looking ahead to substantial opportunities. Well, we'd always expect somebody to say that. Our order book is almost at the same level as September 2013, despite challenging economic conditions. So we've got a report here that's perhaps putting a positive spin on something that perhaps ought to be more reasoned. It looks to me like the company's running out of money. It's having to borrow more. Its margins are being eroded. Its competitors are winning business from them. And so things aren't all as rosy as Daniel would have us believe as investors. So we've got the statements of Constructmore, and we can compare one competitor to our own business. And again, if we look at the cost of sales, that's very high, even a little bit more higher than Build's. If we look at the net operating expenses, we see that's much lower than Build. It's a bigger company, yet its other net operating expenses are 100 million lower. If I was the CEO of Build, I'd want to know why. What is it? What is it that we're paying more for than our bigger competitor? And this is the biggest competitor, not just the nearest one. And again, the tax is shown here, and it's in percentage terms, it looks pretty comparable to the level that Build is paying. But it's in the statement of financial position where we see quite some differences. Build has intangible assets of about 200, and Constructmore has 730. What is this difference? 730, almost 2 or 3 times what Build has. We don't understand that. But yet their property, plant and equipment is much lower than Build. Build has 790, and Constructmore, a bigger company, has 125. Why? We need to understand why. We have some current assets due from construction clients, a very similar amount, 480 for Constructmore, 432 for Build, and yet now we have trade receivables, 376 for Constructmore and 23 for Build. So have they got a different model here? Do they give better terms to their clients than Build does? Is that one of the reasons why they're winning business? The most important difference, of course, is cash. 390 million, although it's down from last year, but it's still a substantial amount compared with the 19 million for Build. So if you were looking at which company is going to succeed in a price war, the one with the biggest amount of cash is going to succeed, I would have thought, and Constructmore is way out in front. If we look at borrowings, non-current borrowings 23, current liabilities 123, so their gearing seems to be much lower than Build. Again, a big worry for Build, I would have thought, because if you've got low gearing, obviously you've got the ability to increase that gearing and borrow, and if you're in a competitive environment, you're going to be able to outlast companies which have got higher gearing. We have some key ratios. These need to be checked. If they're correct, the return on capital employed for Build has fallen quite significantly for 4%. The gearing is constant. If we look at the gross profit of Constructmore, it's pretty low. Net profit is the same. Return on capital employed, very similar. And gearing. Gearing appears to be the same, 44 to 45, but I think we need to check this. I'm not sure that number is correct, and we need to check all of these to make sure that they are the right numbers and they've been calculated properly. Just because they're here printed out doesn't mean that they're correct. So I would check all of those to make sure they're right before we use them to make any decisions. So every 6 months the subsidiaries put in their management reports, and they're consolidated into a summary management report for the board. Again, 6 months, too long and far too summarized. Not enough detail for any board member to really understand what's going on. The detail is too limited. There's no variances, there's no explanations, and the materiality of something, it needs to be looked at. For example, if the margins or the gross profit percentages change here in this civil engineering area, it's going to have a much bigger effect than it does here. So I find this report very ineffective for a board of directors. These graphs, useless. That was the word I wrote when I was looking at it. What do they add to this information? They're just saying the obvious. There's nothing about these graphs that help understand what's going on. In the scale of things, we can see that civil engineering is hugely different. But from a board's point of view, if I was a board member and received this, I would sack whoever produced it for me. Useless. So then we have a series of key performance indicators and a commentary from each CEO. So let's have a look at civil engineering first. We've got 3 KPIs: repeat business, client satisfaction, and committed forward workload. Are they the right ones? Are they the appropriate ones? Probably too limited and too vague to be useful. If we look, for example, at a balanced scorecard, we might have some KPIs that looked at the business holistically. This business in particular is the driving force of build, and we need to know much more about it, not just a percentage of repeat business. What does it mean? It's useful, but is that the most important thing? Client satisfaction, well, it's falling. But let's have a look at the commentary. Whenever you see the word an ambitious budget, you've got to ask yourself, well, who would write an ambitious budget? And in a report, once you've accepted a budget, you can't say it's ambitious. It's the budget that's been agreed. So the budget is, so this, when people write that, it says to me they're making excuses. Delighted that the percentage of repeat business is holding up so well and only just below budget. Well, it's a drop of about 15% from budget, so that's not very good. 83% client satisfaction is a very high percentage. It may well be, but what is it for other people? But it's falling. That's the main thing. Satisfaction rating would have been much closer to budget without the ongoing problem with defective windows. We hope, again, this word hope, never put that in a report. We expect this issue will be resolved shortly and will not arise in the future as we've found a new supplier. Okay, so the new supplier is going to provide things ongoing, but what about all of the other projects that have been completed that might have the same windows? Again, a bit of a head in the sand. Forward workload remains a serious concern. We have a number of bids awaiting decisions and are hopeful the situation will improve. So what does hopeful mean? What are we doing about it? What happens if they don't win them? What are the alternate plans? Are there any plan Bs or contingency plans? We are proposing the board should request all regional subsidiaries to report bids made and work won on a weekly basis. Maybe that's a good thing, but are you then going from not enough information to the board to lots of information? Because in a budget, the timing of things, it can't be done on a weekly basis. So I'm not sure that's going to really help very much. So then we have a look at the development business, and what is the key performance indicator? Just one: expected completed value. What does it mean? It's impossible to know. Doesn't say anything about what speculative investments are being proposed and what sort of rules are being in place to select them. Sales of industrial units are progressing well. The disappointing shortfall in revenue is entirely due to the delay in the sale of our major office centre in the capital city. I would emphasize this is a delay only. The buyer has still to resolve funding issues. Well, if they can't get the money, there's no sale. I mean, is this hopeful? The sale remains agreed, and we've taken advice from our legal team, who consider it likely the sale will be completed. Is that likely to happen? Who knows? But if you've only got one buyer and they're having funding issues, then what is the risk? The risk is that that won't go ahead. So hoping it will go ahead is perhaps not a very good way to describe it. I also have a question about this held for sale. If we look at the September consolidated financial position for Build, assets held for sale 43 million. Now, is that this building here, major office and retail leisure center, 43 million? Sounds pretty low. And if that's the case, how does it relate to this, and how does it relate to profit? So it's all a bit vague for me. So now we've got the investment subsidiary, we've got occupancy rate and average rent per square meter. I think they're pretty reasonable KPIs. We might need some more, but they're perhaps more realistic. They're well calculated. We understand what they mean, and we have a budget worked on the same basis, so I think they're pretty good. The investment makes steady and reliable returns. Steady and reliable are good words to hear. They're much better than we hope, we expect. Just down here we can see that we haven't been forced to reduce rents or offer excessive rent-free periods. I would just add the word yet. In a competitive environment, obviously that's one of the things that's going to happen, so you may as well perhaps plan for it. But other than that, this seems to be like a reasonably well constructed report, albeit brief. Finally, we have two pieces of news announcements, press releases. And the first one is construction news, and is talking about what's the future for construction in Sealand in 2015 by the economics editor, dated January 2015. So this is 3 months before these management reports that we saw, we just looked at. The construction industry is notoriously cyclical. That's pretty normal. This article is looking at businesses with turnover in excess of 100 million, 63 companies, so a lot of competition in this business. 5 fewer than last year, so one company's gone into receivership, another 4 have had their revenues decline below that. So maybe this is a start of a downturn if it's cyclical. Construction output has increased, so if output is increased and yet business is finding it difficult, that means perhaps that margins are being squeezed. It certainly happened here in Australia many times. This may not be too damaging. There's also evidence of capacity constraints. Subcontractor availability falling sharply, and steep increases in the demand for construction materials. 2 alarm bells ringing. For example, we saw earlier that Southwest had lost some business and had excess capacity. Well, what's going to happen now? Where are those subcontractors going to go? They're going to go to business with their competitors. And will you be able to get them back? Possibly not. So keeping these skilled people is very important. And if we've got increases in the demand for construction materials, supply and demand goes up, maybe the price goes up as well. So again, having the agents on site buying materials separately might not be a very smart business practice in this sort of environment. It's always a struggle because big businesses comprise a small number of large contracts. And when these contracts are finished, for example, a shopping center that's just been finished and being sold, it might leave a void in the order book. The average gearing ratio of the sample companies was 17%, with 12 of those having no debt at all. So compare that with Build's 44%, and I think we need just to recalculate Constructmore's because I'm not sure theirs is correct. I think that's pretty low as well. So 44% when the average is 17, and some 12 of these, 20% of the companies have no debt at all. That's a big concern for Build. Return on capital employed averaged 23%, and operating profit 1.5%. So that's pretty typical and consistent with what Build is experiencing. 7 of the companies had a company health score that was low enough to cause concern that they may be financially vulnerable, and I'm going to suggest that Build may be in this category. How many companies will survive rising costs and downward pressure on prices, highly competitive market? Even the largest will struggle to maintain their forward workload. So alarm bells ringing everywhere. The next press release is called PFI, the way forward for Sealand, and PFI stands for Private Finance Initiative, which has been widely used in many countries as a procurement method. And after a series of successful pilots, this type of finance is now to be used in Sealand for the provision of new schools, hospitals and roads, so major construction projects in the public sector. PFI comes under the broader term of PPP. This is the term that's used in Australia, public-private partnerships. And in this case, under PFI, the private sector developer pays for the construction of a project on behalf of the public sector client, and once it's built, the developer leases the resulting school or hospital or road on a fully serviced basis for the expected life of the buildings. So the developer provides cleaning, catering and maintenance facilities. So this is a big change in the model, the business model of the construction business if you want to be in the public sector arena. So the good thing for the public sector is that they can improve public infrastructure without having to find the money up front. The developers are taking a chance, a bit like in Australia where companies build toll roads, for example, and the toll pays them back over time, and the state government or the federal government don't have to find the money to do it. So 2 questions I've got here. This was issued on the 6th of January 2015, and yet it was not mentioned in any of the management reports that we've just seen for March 2015. So why wasn't it mentioned? And the second question we need to know is what percentage of Build's businesses is currently for the public sector. I mean, if they don't do any public sector, then this is not important. But if they do that, let's say 20% of their business is public sector, then they're going to have to change their business model very seriously to take this into account. They're going to have to fund the development of the project, and they're going to get their money back over a long period of time. So there's going to be a long-term investment. So this is a completely different model, and for a company that's already highly geared and has not a lot of cash, this is not going to be very attractive. So this is going to be much more attractive to somebody like Constructmore, who've got funds, they've got the ability to borrow, and so this is a very dangerous scenario, in my view, that should have been mentioned in all of those management reports. It should have really flagged to the board if the board didn't understand this change. So let's go back here to the press announcements announcing the initiative. The government stated, we hope PFI will deliver new projects more quickly at lower risk. Well, at lower risk to the public, of course, a lower risk to the government, but a much higher risk to the developer. So the risk has changed. here. Some countries have had problems with PFI initiatives. Certainly in Australia, we've seen several PPP partnerships go bad, where, for example, they build a tunnel or a road, and the traffic that's supposedly to take this tunnel or this road doesn't turn out to be the same, and companies have gone bust. Sealand can learn from others' mistakes. Well, let's understand what these mistakes are, so that these projects represent good value for money for the taxpayers. So the spokesman was questioned about a public inquiry into a neighboring county about a big city hospital. The project suffered from major cost overruns. Building spec was constantly changing. Well, this is the scope creep. Again, if you don't have a scope that is particularly final, the cost of changing specification increases as time goes on. There have been public protests about the level of cleanliness and standard of food for patients, so now we have a construction company into the business of maintenance of a hospital and into the business of catering. It's not their business. And protesters have claimed these problems are attributable to the developer's incentive to minimize costs in order to maximize profits. Well, perhaps that's exactly what would happen. The government spokesman insisted the PFI team had visited several projects in overseas countries. Although this project has had problems, we've seen many examples of highly successful projects. So again, we need to understand what are the qualities of highly successful projects and what are the mistakes that PPP or PFI initiatives have made. Maybe you've got to do some research on that. We remain confident that partnerships with the private sector can deliver high quality schools and hospitals in Sealand. Well, so that's the end of the case study. So we've got a lot of things to do in film 2. There are a lot of concerns that have raised, certainly in me, about the current status of build, the current status of its management processes, and its current ability to adapt to a more competitive environment, not just financially, but also from a business point of view, understanding the nature of change in business and being able to adapt to it. Being a good engineer is one thing. Managing a public business is another. And the fact that the share price has tanked compared with its competitor tells us that there's probably something else that we haven't heard about yet that is going to be a very important part of the unseen material that you'll get to see when you do the exam. So in film 2, we'll take some of those issues that we've highlighted and we'll explore them more and try and understand what would I need to know to be able to answer a question about this in an exam. So until the next film, it's bye for now.